Hello traders, Gary Wagner here. It is Wednesday, the 11th day of April 2012, approximately 10:30 in Honolulu, 4:30 in New York, and this is the daily report for gold and silver. We do have the precious metals markets this morning not under any substantial pressure, but currently trading lower on the day. Now, in terms of the net changes that we're looking at, gold has been trading very, very quietly and is only trading off a couple of dollars on the day. Right now, about $1.70, putting it down about 0.1%. When we look at the low, 1653, high 1663, you can see there's not a ton of activity going on in that market. Silver, on the other hand, is experiencing a continuation of this recent sell-off that it's had over the last few days. And it is down about 25 cents, a little bit over that, almost a percentage point lower. And as you can see, currently trading 31.50 on the day. Now, traders, one of the fundamental reasons being cited today for the softness in gold in particular is that, and this is according to Bloomberg, in London, the perception is investors right now are selling metal in order to cover losses in other assets amid concerns about the European Union's debt crisis. The other thing that we have been looking at is with the equities markets, which has sold off pretty hard. The belief is here in the States that there are investors moving money out of the precious metals into the equities, believing that this dip here is an opportunity for them to buy. We're looking at a 420 Standard & Poor's 500 chart, put a simple Fibonacci retracement on there. And the reason for putting that on this morning, I'm simply looking at the move that this market has had when you consider this particular rally. It's a huge, huge, long rally. And what's interesting is that when this market hit this top and then came down, as you can see, the retracement level is a 23% retracement level. And of course, 23 or 38 are points that are logical points to look for any type of a correction to terminate and to move back into the prevalent direction of the trend. And in the S&Ps, there is no doubt, but this trend that we're seeing has been an uptrend. Traders, the next chart that I want to look at on today's show is our weekly gold chart, cash market, spot gold, and it's in candlestick format. And in this chart, I have added a couple of lines to illustrate the triangle correction that I believe we are currently experiencing in this market. Now, the interesting thing is there is a diversion from what we typically see in the market. And what I mean by that is that in a standard, or I'll call it a traditional triangle formation, you will get a series of higher lows. However, in this case, as you take a look at it, this is our first low here, and the subsequent low after that was a lower low. So in order to actually draw this triangle formation, we have to fix our points upon our higher lows here and our lower highs here. Now, what does that mean? Well, in an Elliott wave triangle correction, it is composed of 5 waves followed by what's called a thrust line. The thrust line is where it breaks through the apex or top or bottom of the triangle and moves in the prevalent direction of the trend. I think that we can see prevalent direction of the trend has been up. When we look at this chart, traditionally we would call this A, B, C, D, and E, and then the rally that we have been experiencing would be our thrust, meaning the current price ascent that we're looking at. However, to give us a count in a very traditional way, we really need to fix or start our count right here. So this would be our A, meaning we came up here, this is the top, this is our A here. This would be our B, our C. The rally that we're in would be our D. That would take us to the top of this triangle, you would get one more sell-off to the bottom. You would have to get a higher low for this to be valid, and then you would get your thrust line. Now, why is that important? It is simply important for us to note as we hit this particular area right here. My sentiment right now is that we're going to see gold move back above 1700. Depending on how it reacts when we cross this area, meaning when we see the market trade back to this upper band of resistance, if it does break out and continue to move higher, that tells us really that the count started here with A, B, C, D, and E, this being our thrust line. If we find resistance in this area and the market cannot make it above this particular area, then what we're going to see is our count starting here with A, and then of course as we move up in this market like this, we would have our B here, C, D, final line down here is E, and then this of course would be our thrust line. So we would have one more rally, resistance, one correction, and then a very large breakout to begin our major fifth wave. Traders, we are looking at a daily chart. This is in Japanese average, Heikin Ashi format, and we're looking at that same triangle formation, but in this one we have obviously a lot more detail. As you can see, for now I need to put our count in our traditional manner, and then as I said, we're really going to understand where the count began once, I should say if and when we reach the upper apex of this line, the resistance line here, and go towards the apex as we move out. That being said, we are long roughly 1650 on an average price. If in fact we get a lower high as this triangle comes closer together, meaning closer to the apex, if you look at where that would carry over, that would take us into the mid 1700s, 1730, 1750 in that area, because this could falter at any moment. But if we see the market then correct and come back down, what we do know is this: we will have our final E wave on this last correction, and the beginning of our major fifth has got to be really strong. When this breaks out, the energy that has been created during the period of compression is going to be released. We could see a substantial, tremendous move to the upside according to Elliott wave theory, and that's something we certainly want to pay attention to. Traders, the last chart that I do want to look at is going to be our silver chart. And as you know, according to my commentary the other day, and I'm looking at a series of prints that I wonder if they're even legitimate as it goes back between 3156 and then the next print, of course, is 3094. But here's what I see. We absolutely have a divergence, a difference in what we normally see in terms of the gold-silver ratio and the way that they tend to move. They have traditionally tended to move in tandem, and on days where you have nice gold prices rising, you get silver prices rising just in the same way. What we have noticed over the last week or so is that when gold is moving up, silver is flat, and when gold is moving down, silver moves down in tandem with it. There's a lethargic price action that we're noticing in silver, and really we're also noticing pressure to the downside. Traders, to me, it's absolutely critical on a closing basis we get above 3179, because I fear if we cannot, it will play and make a test for these lows. If the market cannot make a new high, it's going to strive to make a new low. My fear is right now, if we cannot on a closing basis see silver go above, call it 3180, we're probably going to come and retest these lows. It is certainly not trading in the same manner as gold. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.